Hey there, accounting enthusiasts and business owners. Welcome to another video on Concierge CPA. I am Juliet, and today I'm going to go over everything you need to know about bank reconciliations. In this video, you will learn what a bank reconciliation is, why it is important, and how to prepare one from scratch. By the end of this video, you will know how to reconcile your bank balance to your financial books like a pro. So let's go. Let's start with defining some basic terms. First, what is a bank reconciliation or bank reconciliation statement? A bank reconciliation statement is a basic and fundamental accounting process. It provides exactly what it says. It reconciles your bank balance and transactions to your financial records in your accounting books. It is a standard practice for businesses to reconcile the bank account statements they receive from the bank to the cash account in their financial books. The reconciliation is needed to help identify errors, irregularities, and adjustments to be posted in the cash accounts. And they are crucial for confirming the actual amount of cash available in the bank, which often differ from the balance of the bank account statement. We will go over that shortly. Preparing a bank reconciliation is not only a process, but also a critical cash control. In businesses, they are typically prepared by a person not otherwise involved in the cash receipts and disbursements functions, to help establish separation of duties and deter fraud by requiring collusion for unauthorized actions or transactions. Since the banks provide statements on a monthly basis, bank reconciliations are typically performed on a monthly basis as part of the routine accounting cycles. But some businesses may reconcile more frequently to closely monitor their accurate cash balances. There are many different formats for the reconciliation process, but they all accomplish the same objective, which is to compare the cash balance for the bank statement to the cash balance for the accounting books, to identify all the reconciling items and calculate the correct cash balance the business holds. Before we go over 5 easy steps to prepare a bank reconciliation statement, let's discuss the items that cause differences in your bank statement and your cash account in your accounting books. Differences in your bank statement balance and your cash accounts are caused by 4 different categories: omissions, timing differences, errors, and fraud. Omissions occur if transactions are not recorded at all in the cash books. An omission might be unintentional, such as forgetting to record a transaction, or it may arise from the delayed recording of a transaction you're not aware of yet, such as bank fees. Timing differences. These occur when transactions are recorded in the business's cash books at different times when they are processed by the bank. For example, a check issued by a company may take several days to clear and be reflected in the bank statement. These are called outstanding checks. Errors. Both banks and businesses can make mistakes. Common errors include incorrect amounts being recorded, transactions being completely omitted, or entries being duplicated. Unfortunately, discrepancies can also be the result of unauthorized transactions, which might not be immediately noticed without regular reconciliations. Let's go over some examples of the categories. Here are some examples of omissions. Bank service charges. Fees charged by the bank for account maintenance, transactions, or other services. These are typically deducted directly from the bank account but may not be immediately recorded in the company's cash books. Interest earned. Interest credited by the bank on the account balance may not be immediately recorded in the company's cash book, causing a discrepancy. Direct debits or credits. Automatic payments or deposits made to the account, such as loan payments, electronic fund transfers, that may not be immediately recorded in the company's cash book. Non-sufficient funds checks. For example, checks received and recorded by the company as cash receipts that are later returned by the bank due to insufficient funds in the payer's accounts. These are initially recorded as deposits, but need to be reversed when the deposits do not clear. Here are some examples of timing differences. Outstanding checks. These are checks that have been issued and recorded in the company's cash book, but have not yet been presented to the bank for payments. They reduce the cash book balance, but not the bank balance until clear. Deposits in transit. These are deposits made by the company that have been recorded in the cash book, but have not yet been processed and credited by the bank. They increase the cash book balance, but not the bank balance until processed. And what could cause errors? So here are some examples. Mistakes made by the bank in processing transactions, such as incorrect debits or credits to the account. Or there could be accounting errors, mistakes in the company's own record keeping, such as omitting transactions or recording incorrect amount. Now that we have a good overall understanding of what a bank reconciliation is, let's prepare one together using 5 simple steps. So this is what we're going to do. Number 1, we're going to compare the bank to the book balances and transactions. Number 2, we're going to identify the differences in the bank statement. Number 3, we're going to adjust the bank balance in our bank reconciliation template. Number 4, we're going to identify the differences in the cash account. Number 5, we're going to adjust the cash account book balance in our bank reconciliation statement. Once we are done with these 5 easy steps, we will have our true reconciled cash balance. So let's do this. Step 1, compare bank balance to the book balance and the transactions. We're going to enter both the bank and the cash book balances in our bank reconciliation statement template. This is a very standard and simple bank reconciliation template that I created in Excel. We start with the name of the business on the top and the date of the balances we are going to reconcile. In our case, it is July 31st. The top portion of the reconciliation is for the bank balance and transactions, and in the bottom, we're going to enter the information from the accounting records. First, we enter the bank balance on the top portion. For the bank statement, we have the balance in the bank as of July 31st is $56,244. We look in our accounting records and we see that as of July 31st, our cash account shows a balance of $60,548. Using this template, we are going to determine what are the transactions that make up the differences between these two balances and determine our true cash position as of July 31st. We're going to do that by comparing the two records, the bank statement and the cash account detail, and identifying the transactions that do not have a match. So let's take a look. We're going to go down the list and check off the matching transactions. Once we're done, we are left with the transactions that are contributing to the difference between the two balances. Now, we are ready to move on to step 2. Step 2. Identify the differences in the bank statement. Now that we have identified the transactions that make up the differences, step 2 will be very easy. All we need to do is take a look at the cash account detail and identify the transactions that do not have a match in the bank statement. These are the reconciling items we will add to the template to adjust the bank balance, because we have already determined that these amounts are not included in the bank balance. So if we take a look at the items that we have not highlighted, we have 3 checks and a deposit. So this takes us to step 3, which is adjust the bank balance. Now we enter in the top portion of our template the transactions in our cash books that are not in the bank. This will adjust the bank balance we have previously entered. We add customer collections in the amount of $10,000 that we have recorded in the cash account in the accounting books that do not yet appear in the bank. These are deposits in transit, an example of a timing difference. We then deduct the checks we have identified that were recorded in the cash account in the accounting records but have not yet been presented to the bank for payment. These are outstanding checks. We then do the math and calculate our adjusted bank balance as $60,044. And now we're ready to move on to step 4. We identify the differences in the cash account. So by taking a look at the items in our bank statement that have not been highlighted, these are amounts that appear in the bank but not in the cash account. So we go back to our template and proceed to step 4, which is identify the differences in the cash account. Again, a very easy step, as we have already marked the transactions in the bank that are not in our accounting record. So moving on to step 5, adjust the cash account book balance. In our final step, we now enter in the bottom portion of the bank reconciliation template the transactions in our bank statements that are not in the cash account accounting records. These will adjust the book balance we have previously entered. We add interest earned in the amount of $50, and we deduct the ATM fee of $4, utilities ACH in the amount of $400, and a service fee of $150. These are all transactions not recorded in the cash books. We now do the math and calculate our adjusted book balance as $60,044. Now remember, these are not timing differences, but omissions. That means that they are not in the cash account. Therefore, they need to be recorded in the accounting records via journal entries. We now compare our bank and cash adjusted balance, and we see they tie. Therefore, we have our true cash position in a completed bank reconciliation. And that's it. So, in summary, bank reconciliations are crucial for confirming the actual amount of cash available in the bank, detecting errors, fraud, or unauthorized bank transactions, and ensuring that all transactions are recorded correctly in the company's accounting system. That is all for this video. If you like this video, don't forget to like and subscribe for more accounting knowledge. If you have any questions, leave a comment below. Thank you for watching. See you next time. Bye.